It's my pleasure to introduce our keynote speaker, Dr. Selma Hepp. I first met Selma probably 10, 12 years ago, something like that, and I learned that she had gotten her PhD recently from the University of Maryland, and her PhD was about when the inflection point was that people started returning to cities after suburbanizing in the years after World War II. And so I did what something I'm sure you all do after you first meet someone is you go out and you find their PhD dissertation, you read it. And I was so impressed with it that I decided to become a Selma Hepp fan from then on. She's actually had a remarkable career. I'm a total sucker for people who've had to overcome a lot to get where they are. And among other things, she managed to get herself out of what was then Yugoslavia, Yugoslavia had broken up, but in the midst of the Civil War, to the United States. And the way I'll characterize it is each of her degree, from a bachelor's degree, which she just got herself here to go to college here, to her master's degree, to her PhD, she went to increasingly prestigious schools, which meant that she must have been the best at what she was doing at the previous school. And she has since then held a series of positions to the point where now she runs the economics group at CoreLogic, which I'm sure you know is the leading data vendor of residential mortgage data and residential data in general. And so she's just someone who has really impressed me, not with just the excellence of her work, but the trajectory of her career. And so I'm really thrilled that she's joining us today. And her most recent work is stuff that I think you'll find fascinating because it's something that's a little different for this conference, but it has had a focus on investing in single-family housing for rental, which is an important thing for us to think about in the multifamily market because it's competition for the multifamily market. And she's also done remarkable work on how rents contribute to CPI and how we get CPI wrong because we don't really take into account rents in the right way. And so because of that work, I invited her here to be our keynote today. I'm sure you're going to learn a lot from her. Dr. Hepp, thank you for being with us this morning.
Thank you. Thank you, Richard, so much for those very flattering comments. Richard has been my mentor since I moved to Los Angeles 11 years ago, and I can't say how grateful I am that he thinks so highly of me. So let me start with saying thank you for having me here today. It's very exciting to be in person. Again, obviously, as we can see, as a witness from a lot of people that wanted to stay in the lobby and chat and socialize, which we haven't had a chance to do in a very long time. There's been a lot going on in the housing markets. Financial conditions and housing market conditions have been changing with breathtaking speed since mortgage rates started surging earlier this year. And so I imagine in your business, as much as in our business, you must be concerned or there's some trepidation about what's ahead for the housing market, your business, and the U.S. economy in general. I am fortunate that I am with the company that is a leading data provider for property data. And so we are able, as a result, to keep a close eye on what's happening in the housing market. And we are able to oftentimes see turning points as soon as they happen in the housing market. So I believe that I'm going to bring to you today some of very important and timely trends that are happening in the housing market. Okay, so some of the things that I'm going to talk about today are obviously the cost surge in housing costs that have surged during the pandemic, and how has rent surge, how does it reflect shift in the demand for different properties as well for different locations. As a result of a lot of the migration patterns, we've seen equalization to some extent of both housing costs and rent costs across many markets in the US. But unfortunately, because inflation has been persistent persistent, and not just in housing, but across a number of goods. Federal Reserve has been very persistent on tightening, has been very steady on their course, and as a result, this has led to mortgage rates that are now highest that they've been at least since the beginning of this, at least 20 years. And as a result, affordability has fallen to historical low, and demand has significantly pulled back, at least in the purchase market, but as well in the rental demand as well. And at this point, we are seeing prices and rents decelerate at the fastest pace that we've had in 40 years. And then I'm going to talk a little bit about how does rent inflation, how is it accounted in overall inflation measure, CPI. We have seen CPI today came out, and it's at least a little bit more favorable than it's been, in the sense that it came under the expectations, and it's suggesting some rate of deceleration in inflation, which could be potentially good for Federal Reserve's approach going forward. And then I will talk a little bit about investor activity. We are able to observe investor activity in our single-family purchase data. And so I want to talk about a little bit of geographic distribution, the type of investors, and how investment activity has been impacting home prices and rents particularly, because what we found is that rent appreciation leads investor share or investor activity, not the reverse, and it's something that it's opposite to what a lot of people have been saying. Okay, so why I'm here, why it matters, why single-family market matters. I thought I should just put this slide up because this is a multifamily conference, and I'm going to talk mostly about single-family market. So why does it matter? Well, single-family housing is the largest segment of the housing market. The two pie charts that I'm showing you here, the one on the left is a owner-occupied distribution among types of properties, and the one on the right is renters. So 92% of homeowners live in single-family, either detached or attached unit, while 33% of renters live in either attached or a detached property. So it is a very important component, and there is a symbiotic relationship between single-family and multifamily housing, and also there is a spillover, a lot of spillover effects, right? So let me start first by looking at what's happened with single-family home rents, rent index, and home price index. So these are both indexes that we produce at CoreLogic, and the blue line is the home price index. And what's one thing that first sticks out in my mind is how much more volatility we've seen in the single-family, in the purchase market in comparison to single-family rent market, and so prior to the pandemic, single-family rent index has been increasing pretty steadily at about 3%, 3 to 4% rate on a year-over-year basis. Now, when the pandemic started, which you can see by a perpendicular line, which indicates March 20th, the onset of the pandemic, you can see that not only home prices started surging, but rents, after a short lag, single-family rents started surging as well. And so moving into the pandemic and the acceleration in home price growth and rent growth, we've seen both peak in early months of this year. So single-family rents peaked at about 14% in March of this year, while home price index peaked at about 20% in early months of this year, and then have since been decelerating. You can see that they're decelerating at a pretty fast pace, and a lot has to do, obviously, with what's happening with the mortgage rates. Now, overall change in the HPI and single-family rent index has been quite substantial since the onset of the pandemic. So home prices are up about 40% since February of 2020, while single-family rents are up about 26% since the onset of the pandemic. Now, the other thing that happened is we saw, in a sense, convergence of price growth trends among different price tiers. So this slide is showing you single-family rent index broken down by different price tiers. So we have low tier, high tier, and then low, middle, high, and then the one I was showing you on a prior slide is the median one, right? So first things first, low tier, the red line, if you focus on the red line for a second here, Red line has been growing at a relatively more rapid pace prior to pandemic, and that's not unexpected. We've seen a lot of demand going into the from first-time or millennials coming into their own households and driving that demand, as well as first-time buyers, in a sense, who weren't able to purchase a home and then moving into single-family rental market. But the rate of growth for low tier was exceeding that of high tier, which is the orange line. Now that changed after the onset of the pandemic. So after March of 2020, the orange line actually starts speeding up at a faster pace than the red line, and then all of them at some point in 2021 converged. And this is something that we also saw in purchase market, a much faster rate of appreciation for lower price homes than higher price home, and that reversing during the pandemic when a lot of demand was shifted towards higher price home. Luxury homes did really, really exceptionally well during the pandemic. And then again, we have the point at which mortgage rates started surging and all of the indexes started decelerating. But at this point, high tier index is decelerating relatively faster than the low tier index. And there's, in my opinion, there's an explanation for there, which is that during the pandemic, there were a lot of households that were moving to locations that they were seeking, different amenities, right? They didn't want to necessarily be stuck in an apartment in downtown San Francisco, downtown LA, downtown New York City. They moved to areas where they had more outdoor amenities, and they were seeking more luxury properties. And so that's what drove a lot of the demand during the pandemic. Now, since we've been vaccinated, since people started coming back to the office, particularly in 2022, we've seen that pullback in demand for luxury properties. Again, not just the rental, but also for purchase market. And again, not only just due to the mortgage rate increase, but also changes in migration patterns or relocation back to those major metropolitan areas where people fled out of during the pandemic. Okay, another trend here that I wanted to point out is the difference in rent growth between multifamily properties, single-family attached and single-family detached. So one thing that we found during the pandemic was the preference for detached properties. The detached properties here are in light blue line. So you can see the light blue line accelerating relatively more faster and sooner at the onset of the pandemic in comparison to where multifamily or single-family attached. The single-family attaches would be considered condos or townhouses. So attached properties started to actually slow in terms of rent growth when the pandemic started, as well as multifamily. We actually saw 4 consecutive quarters of declines in multifamily rents in the early days of the pandemic. And then again, after we got vaccinated, after we started coming back to the offices, the rent growth for multifamily surged well in excess of that seen for the single-family properties, and actually in some sense overshot in early months of this year, and then has been coming down. Now, there's been a lot of geographic variation in the rent growth that we've seen over the last couple of years. The 2 bars here, one is showing you rent growth in September 2021. The other one is rent growth in September 2022. And what's interesting here is a couple things. Well, first of all, the metros on the left-hand side are the metros that we still see significant rent growth, even despite the pullback that we've seen over the last couple of months. So that would be Miami, that would be Orlando, Florida. To some extent, some of the markets that have done the best in 2022 in comparison to the times during the pandemic have been the markets in Florida. And so one asks, why Florida? Well, we've already had a lot of outmigration to Florida from Northeast markets due to retirees moving out of more colder areas and, seeking that heat and sunshine. But the other thing that happened in Miami in particularly is that we saw a lot of folks leaving, a lot of companies relocating or opening second offices in Miami out of financial centers in Northeast, such as New York, such as Boston, Connecticut, Connecticut, and a number of others. And so a lot of those folks that were reopening the offices or opening second offices in South Florida, and crypto was one of the main drivers at the beginning of all of this, but then there were a lot of other financial services companies that moved. That's what's been driving most of that rent growth in South Florida and Orlando as well. The other thing to note is if you look at Las Vegas and Phoenix, for example, in September 2021, they were some of the strongest rent growth markets. So again, Phoenix has been consistently, in terms of home price growth and rent growth, until earlier this year, one of the strongest markets in the U.S. In terms of home prices, they've seen home prices growth at 30% rate for almost a year consistently. Now, but these two markets are the markets now that we've seen largest declines or slowdown in pace of rent growth compared to September of last year. And again, that has to do with affordability being a big thing. You know, these are the markets where people moved for affordability. And when you have that rate of growth, rent growth in those markets, the markets obviously become more unaffordable. The other point too that I want to make is if you look at the bars that are shaded in lighter colors, such as Boston, New York, Los Angeles, Chicago, Philly, these are markets that actually have seen acceleration in rent growth compared to last year. And so that's interesting because this also reflects that move back to cities, move back to offices, and rent growth in those markets being on par with what we're seeing nationally. And then lastly, just a couple things on California. We have San Diego here, we have Los Angeles here. San Diego was an interesting market during the pandemic because we've seen not a lot of price growth and home price growth and rent growth in those markets because of a lot of out-migration within California. So folks from the Bay Area that maybe also wanted more sunshine and more were seeking more affordability relatively to Silicon Valley were moving out, and there was a lot of job growth in biosciences in San Diego. So that was one of the stronger markets in California that we saw during the pandemic. And Riverside, which is not here, was another one in comparison relative to Los Angeles because it was a more affordable market, and we've seen a larger rate of home price growth there than in Los Angeles. But it is interesting to see that Los Angeles now has seen some acceleration again in rent growth in most recent data. So let me move over to talk a little bit about Federal Reserve. I mean, it's been one of those Federal Reserve press conferences, I think is the most listened to press conference that everybody is tuned in whenever it happens on every month. So, you know, most of you probably know that Federal Reserve has a congressional dual mandate, which one of them is maximum employment and the other one is price stability. After we've seen unemployment rate, which is the top chart, come down significantly over after the surging at the beginning of the pandemic, and we've seen increase in inflation, Federal Reserve has pivoted to focus solely on price stability at this point. It's expected in a sense that we have seen inflation surge currently reach the highest level since 1982. So that's the chart on the bottom. So in August, inflation was at 6.2% in the PCE measure. And as I mentioned today, we've seen some deceleration, but again, not enough for Federal Reserve to pull back some of its rhetoric on the financial tightening. At this point, federal funds target rate is between 3% and 3.5%. At the beginning of this year, we were still at 0.5%. And so we have seen some of the fastest increases in federal funds rate this year that we've seen since back to 1980s. Now, By the end of this year, Federal Reserve is expected to reach a target of about 4.6%, which is much higher than many anticipated and much higher than many have built into the forecasts earlier this year. And as a result of these increases, these strong aggressive increases, Federal Reserve is likely to lead into a recession. So now some folks expect recession to be significant recession. Most of the forecasters are still forecasting a shallow recession. What does a shallow recession mean? Basically, it means that in the fourth quarter of this year, we're going to see a slight decline in GDP, less than 1%, about 0.3%, and that decline will continue through middle of or third quarter of next year, and then turn into positive territory. So overall, about 1% decline in GDP. On the other hand, though, on the top slide here, you're looking at a forecast for unemployment. At this point, unemployment is expected to reach about 6% as a result of Federal Reserve's policies, and it will be slightly higher than what is considered a full employment of 4 to 4.4%. Now, one problem that Federal Reserve is dealing with is the contribution of shelter costs to overall inflation measure. And because of the rising costs and of rent and home ownership, there is a significant impact on inflation and inflation measure. The two pie charts here are showing you a distribution of inflation measure across different categories. And so the one on the left is CPI, the one on the right is PCE. Nevertheless, just different ways of looking at inflation. But in both measures, rent component or shelter component of the inflation contributes about 20 to 40% to the overall inflation measure. Particularly the one that we talk most frequently about is CPI. Federal Reserve pays more attention to PCE, but in CPI, the rent component is as much as 40% of the inflation. Now, the problem with both of these measure of the way shelter is calculated in these is that it's based on a survey that surveys all tenants. So it doesn't only survey new tenants or new lease signs, but it surveys all tenants. As a result of that, it tends to catch changes in the market conditions with a lag. And so in each month's survey, it only captures about 1/12 of a change in what's happening in the market. And so what we did at CoreLogic, we looked at what the relationship between single-family rent index and shelter component of CPI, which is owner's equivalent rent. And so what we found is that because of the delay in or a lag in the way the data is captured, there is a 9 to 12 months delay in seeing those tipping points or turning points in the rent inflation or rent change. As a result of that, we will continue to see an increasingly higher contribution of shelter in inflation, overall inflation measure over the next year. And it's not expected to peak until summer of next year at about 9%. Usually it's only about 3 to 3.5% increase on a year-over-year basis. Now it's going to reach about 9% through end of or September of next year. And that's really important in how Federal Reserve perceives inflation and how tight they decide to continue with their policy and their persistence on lowering inflation to 2%, which they have been pretty steady in suggesting that there is no variation away from 2%, that they are steadfast on that 2% inflation measure. The other thing that happened, or one of the most important things that's affecting our housing market as a response to what Federal Reserve is doing, is the surge in mortgage rates. So mortgage rates have surged at the fastest pace since 1980s, and they've increased some 400 basis points from the beginning of this year to where we are today. And so the other issue, unfortunately, they've seen as a result result of financial tightening is that we've seen a lot of volatility, we've seen a lack of liquidity in the market, and as a result of other global geopolitical conditions, there's been a lot of uncertainty about future steps that Federal Reserve will take. And so the mortgage spreads have, as a result, widened, and they're now at the widest range that they've been since 2008, which is prior to the Great Recession. And so at this point, forecasts for mortgage rates are really wide. The purple area here under the forecast show you just how wide the range of forecasts are among those who do this for living, forecast mortgage rates. And it is actually a result of that uncertainty of what is going to happen with mortgage rate spread. But nevertheless, most do expect at this point for mortgage rates to level off at a much higher level than we anticipated coming into this year, or even, you know, the discussion was in years prior to the Great Recession or prior to the pandemic. High mortgage rates, high home price growth. We've seen erosion of homebuyer affordability. The line here is showing an inflation-adjusted typical mortgage payment, which is now at the highest that we've seen on record. It's even higher than was at the peak of pre-Great Recession housing boom in 2006. You can see that now it exceeds some couple $100. Again, it's inflation-adjusted, so it does account for a lot of the other movements in terms of affordability. But what's interesting here is that just between January and September of this year, we've seen a jump of almost 50% in that expense. And this is an expense on the same type of home being today compared to earlier this year or last year. And so as a result of that, we've seen a significant pullback in demand, home buying demand. This chart is showing you total home sales activity over the last, going back to 2000, year 2000. And 2021 was the strongest year that we've seen since going back to pre-Great Recession. And we were expecting 2022 to be even stronger coming into this year. But at this point, we're looking at about 18% decline. The result of that, nevertheless, in terms of home prices, has been a significant pullback in home price index. So the map here is showing you the change in home price index from peak month this year to September of this year. And in 2/3 of markets, we've seen price decline. One thing to note is that this year started off with the fastest rate of acceleration in home prices that we've seen because of the anticipation of higher mortgage rates. A lot of folks were jumping into the market, were bidding much higher than the asking price. And so in the first 3 months of this year, we've seen 10% increase in home prices just in those first 3 months of this year. And so we are coming off of these peaks, but in many of these markets, we are still higher than we were a year ago. So on a year-over-year basis, home prices are still up, and in many markets, still at double-digit rates. The other result has been deceleration in single-family rents. And so I mentioned strong rent growth in Miami. Miami has seen strongest rent growth, strongest slowing in rent growth since its peak in April of this year. So that rent growth is down 16 percentage points from April. Now, again, why Miami? You know, financial services have been hard hit by higher mortgage rates, and there's been some layoff in that sector. So to some extent does explain why that pullback in rent demand in Miami. Okay. A few slides on single-family investor shares. So the other thing that we saw during the pandemic is an increase in investor activity for single-family purchases. The top line is showing you share of purchases that were done by investors. And so while we were at about 15 to 18% average prior to the pandemic, that share surged to almost 28% in 2021 and remained elevated since then. It was 27% in October of this year. But with much fewer home sales, that is more overall homes being purchased by single-family investors. We are still looking at about 100,000 properties per month being purchased by investors nationally. The other thing is that, what we are able to see in our data is the difference. We generally, when we talk about investors, we think about institutional investors and large investors. There are, however, many different types of investors. There are small investors and there are medium-sized investors. So we are able to break down these trends, and what we see is that the investor growth was actually driven by non-mega investors. Mega investors would have 1,000 properties or more. So it was driven by non-mega investors during the pandemic. The other thing is where these or small investors, non-mega investors were investing. And so I circled in red markets in California. So these list of markets, total list of markets, are the top 20 high investor markets with investor share of 30 to 40%. And so you can see in many of those are in California. But a lot of those markets, the demand was driven by small and medium-sized investors. So that's the red lines, red bars, and blue bars. On the other hand, when you look at the right-hand side, these are the markets where we see more mega or large investors, and these are the markets that we've seen already high level of mega investor or institutional investor purchases, such as Atlanta, such as Memphis, Dallas, Arizona, Phoenix, Arizona, Tennessee. So these are more affordable markets that have had a lot of population growth, and as a result, we've seen more mega investor demand. This chart, which looks at the correlation at investment activity and home price growth and rent growth. So the correlation with rent growth is on the left, and correlation with home price index is on the right. So you can see that overall, there's been a stronger correlation between home price growth and rent growth. But since we are talking about rents today, what we wanted to understand better is, are the investors drivers of the rent growth, or is the rent growth driver of investor activity in those markets? And so what you can see on the right-hand side from higher correlation is that when we lagged annual single-family rent change with investor share, it was the rent that drove investors to come to those markets. And so the last slide here that has two maps, I want to close with this slide, which looks at the population growth across the country and population growth between 2015 and 2021, and then also going forward from 2021 to year 2030. And so a couple of things to point out here. A lot of population growth we saw over the last few years has been in Mountain West areas, has been in Arizona, has been in Texas, has been Florida, has been in Southeast markets. And so that's also where we saw a lot of rent growth, a lot of home price appreciation. But looking ahead, some of the same markets that were growing up until this point will continue to see strong increase in population. And some of the strongest acceleration in population growth is actually going to be in markets in Texas, in Arizona, and New Mexico. And why that matters is because when you look at where mega investors, institutional investors are going, they are going to those markets where we're likely to continue to see a lot of population growth, and as a result, a lot of rental demand and home purchase demand.
The graph that made me really want to invite Selma is the one that showed that investor activity lags rent growth, doesn't lead it. And so, there's a narrative out there about how rents are being driven up by Brookfield or Colony or somebody. And what this work shows, it's really not. And the other thing that was extraordinary is that the mega guys are just a tiny fraction of this in general. So really enlightening stuff. So thank you very much.